Look, I need you to sit down for this one because what just dropped is not a rumor. It is not a prediction. It is not somebody's opinion on the internet. A regulated European investment firm managing billions of real dollars just published something they probably didn't expect you to see. $133 silver, $6,000 gold this year. And buried inside that same report is a confession that the crash you witnessed, the one that shook your confidence, wiped out your neighbors, was never an accident. They engineered it. And the evidence is hiding in plain sight. Welcome to John Analyst. If you're joining us for the first time, think of this channel as that one wise friend who reads everything you don't have time to read and tells you exactly what it means for your money. Now, before we go further, if you're someone who's lived long enough to remember when a dollar actually meant something, do yourself one favor today. Hit that subscribe button, not for us, but for yourself, because the information on this channel is the kind your banker won't call you about, and we'd hate for you to miss what's coming next. Now tell us in the comments, where in the world are you watching this from today? Because what we're about to reveal affects every currency, every savings account, and every business decision, no matter where you are. There are moments in financial history when the institutions reveal more than they intended. This is one of those moments. In the early weeks of 2026, a major European investment firm, AG Funds, quietly released their official market outlook for the year. This was not a blog post. This was not a social media prediction. This was a formally published, legally accountable document prepared by a regulated institutional fund managing billions of dollars on behalf of pension funds, sovereign wealth clients, and high net worth allocators. And inside that document was a number that stopped serious analysts cold: $133 per ounce for silver. This year, not as a possibility, not as an optimistic scenario, as a base forecast. Alongside it, $6,000 per ounce for gold. Now, before you process those numbers through the lens of what silver is trading at today, understand something critical. Institutions like AG Funds do not publish aggressive forecasts for attention. They publish forecasts because their clients, the kind of clients who manage generational wealth, demand analytical accountability. These are funds that get sued if their projections are reckless. Their entire credibility infrastructure depends on conservative, defensible analysis, which makes what they published extraordinarily significant. When a liability-bound institution tells you silver is going to $130, they are not speculating. They are warning. And the business community needs to understand the difference. Speculation is what happens on retail trading forums at midnight. Institutional forecasting is what happens when teams of economists, commodity analysts, and geopolitical strategists spend months stress testing models against real capital exposure. The output of that process, the number they ultimately publish, represents the floor of their internal conviction, not the ceiling. In other words, if AG Funds is telling their clients $133, the number they're not publishing may be considerably higher. So what is driving this forecast? To understand it properly, you need to step back from the price chart entirely. Because this is not a story about silver. This is a story about what silver represents in the current global financial architecture. Silver sits at the intersection of two powerful forces that are simultaneously accelerating in 2026. The first is monetary. The global financial system is carrying a debt load that has now crossed $350 trillion. Central banks, having spent decades suppressing interest rates and expanding money supply, have created a structural environment where the purchasing power of paper currency is in a state of managed, continuous decline. This is not a conspiracy. This is published Federal Reserve and IMF data. When currency loses its store of value function, hard assets, gold, silver, real productive capacity, absorb that displaced value. The second force is industrial. Unlike gold, silver is not purely a monetary metal. It is a critical industrial input. Solar panels, electric vehicle components, advanced semiconductor manufacturing, medical technology. The global transition toward green energy infrastructure has created a demand profile for physical silver that did not exist 20 years ago. Supply, meanwhile, has not kept pace. Mine production has been structurally constrained. Exploration investment declined sharply through the low-price years, and above-ground stockpiles have been quietly, systematically drawn down. This is the architecture behind the $133 forecast. Not hype, not fear-mongering. Supply mathematics meeting monetary reality. And here is what makes this moment particularly important for the business community specifically. Not just for investors, but for operators, for entrepreneurs, for anyone making capital allocation decisions in 2026. Institutional money does not wait for public confirmation. It moves before the headline. It positions before the crowd arrives. The fact that AG Funds has now published this forecast publicly means one thing with high probability. The smart capital has already moved. The positions are already being built. What you are reading in their Outlook document is not the beginning of the trade. It is the announcement that the trade is already underway. The question for every serious decision maker watching this is not whether silver reaches $133. The question is, where will you be positioned when it does? Because what this institutional report reveals next, the mechanism behind the engineered crashes, the deliberate transfer of retail wealth to institutional balance sheets, is something far more calculated than most people are prepared to understand. They didn't steal from you loudly, they did it quietly, methodically. While you were watching the price fall and convincing yourself to sell, let's establish something that most financial commentators will never say directly on a mainstream platform, because saying it clearly with evidence makes certain powerful institutions deeply uncomfortable. The silver market crash you witnessed in recent weeks was not a market event. It was a managed operation. And the proof is no longer sitting in the realm of theory or speculation. It is documented. It is institutional. It is inside the same Ag Funds report that forecasted $133 silver. Because buried within their analytical framework, between the macro projections and the supply-demand modeling, is a passage that should have generated headlines across every major financial publication on Earth. It didn't. And the reason it didn't is itself part of the story. The report explicitly identifies what it calls orchestrated pullbacks, deliberate engineered episodes of price volatility designed with a singular purpose: to transfer silver holdings from retail participants to institutional balance sheets at artificially suppressed prices. Read that sentence again slowly. A regulated, liability-bound, multi-billion-dollar European investment fund used the word orchestrated. Not volatile, not corrective, not cyclical. Orchestrated. This is not the language of conspiracy. This is the clinical vocabulary of institutional analysis. When Ag Funds uses that word in a legally accountable document, they are describing a mechanism they have observed, modeled, and apparently understood well enough to build a $133 forecast around. The question every serious business person must now ask is not whether this happened. The document confirms that it did. The question is, how does this mechanism actually work? And more importantly, who is running it? Here is the architecture, stripped of emotion and presented as a process. Physical silver has two markets operating simultaneously. The first is the paper market. Futures contracts, options, synthetic instruments traded on exchanges like the COMEX. The paper market is where price discovery officially happens. It is also where volume dwarfs physical reality by a ratio that should concern every serious analyst. For every ounce of physical silver that exists above ground in deliverable form, there are estimated to be dozens of paper claims representing that same ounce. This structural imbalance creates a mechanism. When institutions want to accumulate physical silver at lower prices, they don't buy it, not initially. First, they sell paper. Massive coordinated short positions enter the futures market. Price drops, algorithms trigger, retail stop losses execute automatically. Leveraged positions get liquidated. The Reddit silver community, watching their portfolios collapse in real time, begins to panic sell physical holdings back into the market. And then, quietly, systematically, the same institutions that sold the paper begin purchasing the physical. At the discount they engineered, this is not a modern innovation. This playbook has generational precedent. In 2008, gold fell from $1,000 to $700 in a matter of weeks. Retail investors, convinced the financial crisis meant everything was collapsing, including precious metals, sold into that decline. Institutional buyers absorbed every ounce. Within 18 months, gold had not only recovered, but pushed toward $1,900. The wealth transfer that occurred in those weeks of panic was one of the largest in modern commodity history. March 2020 told the same story. Silver dropped nearly 35% in a matter of days as pandemic panic spread through retail markets. Physical dealers reported buying surges even as paper prices collapsed. A technical impossibility in a genuinely free market, but entirely consistent with a market where paper price and physical reality have been deliberately separated. Those who sold in March 2020 sold to the same hands, now sitting on unrealized gains measured in the hundreds of percent. The 20% crash that rattled silver markets in recent weeks follows this identical pattern. Leveraged retail positions, liquidated, weak hands, shaken out. COMEX registered inventory, quietly drawn down as physical moves from public vaults into private institutional storage. And now, Ag Funds publishes $133. The timing is not coincidental. The sequence is not accidental. This is capital allocation strategy executed at a scale most retail participants cannot perceive because they are too focused on the daily price movement to see the multi-month architecture surrounding it. The transfer has already occurred. The question that Part 3 will answer is why this moment in 2026 is structurally different from every previous cycle, Why the $350 trillion debt bomb sitting beneath the global financial system makes this particular setup the one that institutions may not be able to quietly unwind when they are ready. Forget the price chart for a moment. Forget $133. Forget the institutional report. Forget the engineered crashes and the paper market mechanics. Step back further, much further, because what is actually happening in silver markets in 2026 is not a commodity story. It is the final chapter of a monetary experiment that has been running for over 50 years, and it is beginning to break. On August 15, 1971, United States President Richard Nixon made a brief television address that most Americans watched with mild curiosity and quickly forgot. In 11 minutes, he suspended the convertibility of the US dollar into gold, effectively ending the Bretton Woods system that had anchored global monetary order since 1944. That decision, made unilaterally without international consensus, did something that most economics textbooks still understate dramatically. It removed the last physical constraint on how much money governments could create. Before 1971, every dollar in circulation required a corresponding gold reserve. Currency creation had a ceiling. Debt had a natural boundary. The system was imperfect, but it was anchored. After 1971, the anchor was gone, and what followed was 50 years of the most aggressive monetary expansion in recorded human history. Here is where the numbers become impossible to ignore. In 1971, total global debt stood at approximately $4 trillion. By 2000, it had grown to roughly $62 trillion. By 2010, following the first great financial crisis of the modern era, it crossed $200 trillion. Today, in 2026, the Institute of International Finance estimates total global debt, sovereign, corporate, household, and financial sector combined, at over $350 trillion. That is not a number most human minds can genuinely process. So consider it this way. If you spent $1 million every single day, from the moment Julius Caesar was born until this morning, you would still not have spent $350 trillion. This is the foundation beneath the global financial system. This is what governments, central banks, pension funds, and sovereign wealth allocators are managing around every single day. And the only mechanism available to make that debt serviceable, without triggering outright default, is the quiet, continuous, deliberate debasement of the currencies it is denominated in. In plain language, they must keep making money worth less, so the debt becomes easier to repay. And when money becomes worth less, something must become worth more. Throughout monetary history, that something has always been the same. Hard assets, productive land, physical commodities, and above everything else, gold and silver. This is not ideology. This is not a political position. This is 5,000 years of consistent human behavior in the face of currency debasement. When paper loses its anchor, metal finds its floor, and then it finds a ceiling nobody initially believed possible. But here's what makes 2026 structurally distinct from every previous precious metals cycle, and why Ag Fund's $133 forecast may ultimately prove to be conservative rather than extreme. In every previous cycle, silver was primarily a monetary hedge. Its price movement was driven almost entirely by investor sentiment around currency and inflation. Industrial demand was a secondary factor, present but not decisive. That structural reality no longer exists. The global energy transition has fundamentally altered silver's demand architecture. A single utility-scale solar installation requires thousands of ounces of physical silver for photovoltaic cell production. The International Energy Agency projects that solar capacity must triple by 2030 to meet climate commitments already signed by over 190 nations. Electric vehicle production, which also requires silver for battery management systems and advanced electronics, is scaling at a rate that was considered optimistic just 3 years ago. The result is a demand profile that is now being driven by two independent and simultaneously accelerating forces: monetary debasement on one side and irreplaceable industrial consumption on the other. Supply cannot respond at equivalent speed. Primary silver mines take 7 to 10 years from discovery to production. Exploration investment collapsed during the extended low-price environment of the previous decade. The pipeline of new supply is structurally insufficient to meet the demand trajectory that both monetary conditions and industrial policy are now creating together. This is the macro architecture behind $133, not a forecast built on optimism, a forecast built on arithmetic, debt that cannot be honestly repaid, currency that must be continuously diluted, industrial demand that cannot be substituted, supply that cannot be quickly expanded. These four forces are not moving toward each other gradually. In 2026, they are converging. And when institutional money, the kind that manages pension obligations and sovereign reserves, begins to recognize that convergence simultaneously, the question is no longer whether silver moves. The question becomes, how many retail participants will still be holding when it does? Because what Part 4 will reveal is not just what is coming. It is the precise strategic framework that separates the business minds who will benefit from this moment from those who will simply read about it afterward and wonder, why didn't anyone warn me? Everything covered in the previous 3 parts was not history. It was not analysis for its own sake. It was not a warning designed to create fear. It was context. Because context without strategy is simply expensive education. And the business community, the entrepreneurs, the operators, the capital allocators watching this right now deserves more than a well-documented problem. They deserve a framework for what to do next. Let's begin with the most important distinction that separates serious capital thinking from retail speculation. There is a fundamental difference between chasing a price movement and positioning ahead of a structural shift. Retail participants chase. They see $133 silver in a headline, feel the urgency of missing out, and make reactive allocation decisions based on emotion dressed as analysis. This is precisely the behavior that institutional money has historically profited from and will continue to profit from in this cycle. Serious decision makers do not chase. They read the architecture. They understand the timeline, and they position before the crowd arrives at the conclusion. The crowd has not arrived yet. The fact that mainstream financial media has not covered the Ag Fund's report with the seriousness it deserves, the fact that $133 silver is still being dismissed in conventional investment circles as fringe analysis, the fact that most business owners and entrepreneurs have not yet restructured their capital thinking around what is coming. That gap between institutional positioning and public awareness is precisely where strategic opportunity lives. So what does intelligent positioning actually look like for the business community in 2026? The first principle is allocation architecture, not speculation. There's a critical distinction between allocating a strategic percentage of liquid capital into hard assets as a store of value mechanism and making a leveraged bet on a price target. The former is what pension funds, sovereign wealth allocators, and multi-generational family offices have been quietly doing for the past 18 months. The latter is what retail traders do on margin accounts the week after headline. The business mind approaching this environment should be asking a specific question, not how much can I make if silver hits 133, but rather, what percentage of my current liquid capital is genuinely protected against the continued debasement of the currency it is denominated in? That is the question AUG Fund's institutional clients were asked. That is the question that produced this report. And that is the question every serious operator must now answer honestly. The second principle is timeline calibration. Institutional forecasts of this nature are not day trading signals. When AUG Funds publishes a $133 target for 2026, they are communicating a directional conviction across a 12-month horizon, minimum. The engineered volatility discussed in Part 2 will not disappear. There will be more orchestrated pullbacks. There will be more moments designed to shake retail confidence and create panic selling opportunities for stronger hands. The business mind that understands this architecture does not interpret a 15% price drop as invalidation. They interpret it as the mechanism functioning exactly as documented. Patience, in this context, is not passive. It is a strategic weapon. The third principle is diversification of exposure format. Physical silver and gold, held in allocated audited storage, represents the most direct form of hard asset positioning. But the business community has additional instruments available. Royalty and streaming companies that hold contractual rights to future silver production offer leveraged exposure to price appreciation without direct commodity storage risk. Select mining equities, particularly those with producing assets and strong balance sheets, historically outperform the underlying metal during major price appreciation cycles. The key analytical filter across all formats is the same. Does this instrument give me genuine exposure to physical reality? Or does it give me exposure to paper promises in a market where paper promises are exactly what is being devalued? That question, applied rigorously, eliminates most of the noise and clarifies the actual decision set considerably. The fourth, and perhaps most overlooked principle, is business operational awareness. For entrepreneurs and operators, particularly those running businesses with supply chains, manufacturing inputs, or technology components, silver's price trajectory is not merely an investment consideration, it is a cost structure warning. Industries dependent on silver as an industrial input. Solar technology, electronics manufacturing, medical devices, advanced automotive systems are going to face input cost pressures that their current financial models have not adequately stress tested. The business owner who understands this now has a meaningful operational advantage over the competitor who discovers it when the invoice arrives. Procurement strategy, supplier contract structures, inventory positioning for silver-dependent inputs, these are not investment decisions. They're operational survival decisions in an environment where the arithmetic of supply and demand has already rendered the outcome largely inevitable. Here is the summary intelligence that this entire analysis has been building toward. A regulated, liability-bound institutional fund has published a forecast that validates everything the macro data has been suggesting for the past 3 years. The engineered crashes were not random. The supply constraints are not temporary. The debt architecture driving monetary debasement is not a short-term policy problem. And the industrial demand transformation reshaping silver's consumption profile is not reversible. These are not 4 separate concerns. They are 4 walls of the same room, and that room is closing. The business community has a narrow but real window. Not because $133 is the ceiling. Institutional analysis suggests it may barely be the beginning of a multi-year revaluation cycle. But because the window between institutional awareness and public realization is the only window where calm, strategic positioning remains possible. After public realization arrives, positioning becomes panic, and panic has always been the most expensive way to buy anything. The question was never whether silver was destined for $133. The question was always whether you would be ready when the institutions could no longer keep the signal quiet. They couldn't. The report is public, the architecture is visible, the window is open. What you do next is entirely your decision. This has been John, Analyst. If this analysis provided you with genuine strategic value, share it with one person in your network who is still making capital decisions without this information. Because the most expensive thing in a shifting economy is not making the wrong move. It is not moving at all.